Hello, everybody. This is Steve Gorin, and welcome to my quarterly newsletter seminar. This one is titled Self-Employment Tax and LLCs, New Partnership Audit Rules, Selected Issues from Heckerling, because we're going to cover all three. For those in the audience who are seeking CLE in New York, New Jersey, or Indiana, you will need to verify your attendance. During the CLE, 3 code words will appear. When the codes appear, you should write them down, as you will need to provide them in the verification form, including the login instructions sent to you. All CLE questions should go to cle-tc@thompsoncoburn.com. Again, first I'm going to talk about self-employment tax and LLCs, then I'll get into these new partnership audit rules that will take into effect just next year, and then we'll talk about selected issues from Heckerling. So first, I'll give you the first code word which you need to write down for your CLE credit, and that is round peg. And that has to do with the whole topic we're going to do, which is fitting a round peg into a square hole relating to self-employment tax and LLCs. So I'm going to cover now this limited partnership exclusion. I'm going to go into the leading case in the area, and then I'll talk about a recent CCA. And before I get into too much, let's just talk about the limited partner exclusion. So there's a statutory exclusion from self-employment tax for limited partners in a limited partnership. Now remember, self-employment tax, how it works, for an employee pays FICA on the first 7.65% of the earnings up to around $117,000 or so, which is increased in 2017. And then after that, the tax is 2.9%, which is Medicare tax. And then when you get to $250,000 in earnings, it's 3.8%, which includes a supplemental Medicare tax. And when you have somebody who is self-employed, so that would be somebody who has their own business that's a sole proprietorship, or they might be a general partner in a partnership. Then you pay the employer's half of FICA and the employee's half of FICA, so it's 15.3% for the first $117,000, $120,000 of that range, and then you get 3.8%, which is double 1.9%. I'm sorry, then you get 2.9%, which is double 1.45%, and then you get 3.8% after $250,000. So people really like to avoid self-employment tax. They do all kinds of things for it. And like I said, limited partnerships have a limited partner exclusion. And before we get into the case and the CCA some more, I want to kind of take a step back and run us through what are the different types of entities that are taxed as partnerships, because you really need that to have a context. So again, the limited partners exclusion is if you have what's a state law limited partnership. You file the registration under state law as a limited partnership. You have a general partner who's the one who controls the whole thing. You have limited partners who do not have rights as limited partners to be active in the business. Now, it used to be that if a limited partner became active in the business, the limited partner would lose the limited liability protection. And that was the case for a while, but that got repealed a number of years ago. Law schools still taught it. Even after they changed the law, a lot of law schools taught that if a limited partner became active in a limited partnership, they would lose their limited liability as a limited partner. That is not the case in the overwhelming majority of the states, and has not been the case for many years. So, in fact, a limited partner can become active in a limited partnership without losing the limited liability protection. Now, what does it mean to have limited liability protection? A person has limited liability protection means that they're not they're not liable for what goes on inside the entity unless they themselves do it. There's nothing that can really protect you from your own actions. The whole point about having some kind of entity that limits liability is to limit you for the actions of other people who might do wrong inside the entity, or to limit you for contractual liability. But there's nothing that can protect you from your own torts. You just need to have good liability insurance and get some good indemnification. So again, a limited partner who's active will be liable for acts they do themselves. There's nothing you can do about that, but they will not be liable for acts that other people do. To contrast that, a general partner in a general partnership generally will be liable for what the general partner does, and we're going to talk in a minute about how you can have an exception to that. Okay, so that is limited partnerships. A limited liability company, or an LLC, is an entity where everybody has limited liability protection. And the limited liability protection, again, it applies to debts that the limited LLC might incur. It will apply to any debts that the LLC would incur, and it would apply to any acts that the owner does not themselves undertake. So in an LLC, you can have a manager-managed LLC, one where you have all the authority for our day-to-day business and concentrated in the power of a manager who might then delegate it out to various people, and the members themselves don't run the LLC. Or you can have a member-managed LLC where the members themselves run the show. And LLCs were not around when this limited partner exclusion from self-employment tax was enacted. So LLCs were not really contemplating by that statute. So a question that arises is, suppose you have a member of an LLC, and it's a manager-managed LLC, and that member is not active in the LLC. Would that person be able to be considered to be like a limited partner and get the exclusion from self-employment tax? Now that is a tough question that's open. Many years ago, back in the 90s, the IRS promulgated proposed regulations trying to say, well, when that would occur and when that wouldn't occur. There was a big firestorm about those proposed regulations, and Congress put a moratorium that for 1 year, the IRS would not be allowed to finalize those regulations. Well, that was in the late 90s, and not only did the IRS wait a year, they've waited forever. The IRS has not finalized those regulations, and they're just proposed regulations. Taxpayers are not legally entitled to rely on those proposed regulations. As a matter of administrative practice, however, the IRS tends to abide by them, and we'll talk about those proposed regulations in a little bit about when an LLC member might be considered to be a limited partner and eligible for the exclusion. But before we do that, I want to get into another type of entity type as a partnership, and that's called a general partnership. And a general partnership is generally governed by the Uniform Partnership Act, and anytime people come together to form a business, to try to earn some money, that tends to be classified as a general partnership. Now, a lot of times people will formally form a general partnership, but you can have an oral partnership, and you can just have the conduct of co-owners forming a general partnership. And in a general partnership, all of the general partners have authority to act. Now, the partnership agreement might limit that authority, but But to third parties who haven't read the agreement or haven't been informed of the agreement, they'll think that all partners have the ability to act, and partners are jointly and severally liable. If one partner does something on behalf of the partnership, each other partner is personally liable for everything that goes on. So that's a pretty scary thing to have that personal liability. And after LLCs came about, people thought, well, is there a way we can have our general partnership and just put kind of a limited liability protection around it, like a little liability shell? So the Uniform Partnership Act was amended in many states to provide that if a general partnership registered with the Secretary of State, they could register as a limited liability partnership, an LLP. And that LLP would provide limited liability protection. Now, it wouldn't change the relationship of the partners. They're still general partners with authority to act. It would simply provide a limited liability protection similar to what you might have by an LLC. Also, at the same time, if you think about that general partners in a general partnership, let's go back now and return full circle to a limited partnership. In a limited partnership, the general partner has liability for what goes on. A limited partnership could also do an LLP registration, and those are called triple LPs, limited liability limited partnership. So we kind of have our alphabet soup. You have a limited partnership, you have a limited partnership that has limited liability protection for the general partner called an LLLP, a triple LP, and then you also have a limited liability partnership. And again, a limited liability partnership is a general partnership. There's no limited partners in there. General partners where everybody has authority to act, but they have limited liability protection. So let's get into this case called Rinkemeyer, and then I'm going to go and talk a little bit about the proposed regulations, and then I'm going to talk about the CCA that came out. So Rinkemeyer was a case that involved a limited liability partnership. It was a law firm. They were limited liability partnerships. So they were general partners who simply registered to have limited liability. Now, the Rinkemeyer case, they said, well, as lawyer, even we have our limited liability protection, so you should treat us like a limited partnership because we have limited liability protection. And the court had none of that. The court said, look, you're all working in this thing. You're general partners. You're not a state law limited partnership. You're not a limited partner in a state law limited partnership. You're a general partner. Okay? There's no difference between you and an LLP and a general partner in just a plain old general partnership. You have the same responsibilities. And there's nothing in the limited partner exclusion that says just because you have limited liability, that means you're a limited partner. There's nothing there that supports that. So taxpayers, you are out of here. We are not going to give you that protection. Now, when the court said that, it was totally justified because, again, they're general partners. They have limited liability protection, but they're general partners. And in the statutory framework, you have general partners and limited partners. And these people were general partners. So the court was absolutely right. But one of the problems is that the court used very broad language, and it said we weren't talking about active people. Congress wasn't talking about active people when it enacted that statute. It was talking about people who were not active in the business. So a lot of commentators have gotten concerned about that because what if you have a limited partner who's active in the business? Does that mean that they don't get the statutory exclusion? And I think there's a pretty easy answer to those commentators, because when you look at the legislative history to the provision that enacted the limited partner protection, the legislative history said, suppose you're a general partner and a limited partner at the same time. Your income as a general partner is subject to self-employment tax, but your income as a limited partner is not. So the legislative history contemplated that a limited partner could be active in the business and that the limited partner would not be subject to self-employment tax on their earnings. The legislative history is directly on point, and you can't really expand the Rinkmeyer case to say that a limited partner would lose the protection from self-employment tax. So I think that the commentators are concerned about that. It's an overblown concern. I think limited partners still get the statutory exclusion. Okay, now let's get into the CCA. In that case, they had people who were active in the business and people who were not, and basically the CCA said that these LLC owner who was not active at all, the IRS did not attack that. They were not active. They did not consider them to be subject to self-employment tax, which was a nice gift, I think, that the IRS gave. The CCA did not apply the proposed regulations. They just said the IRS did not attack it. We're not going to address that issue. What they addressed was an LLC member who was active, and they said, hey, you're active, you're not protected, Rinkmeyer applies, and what the taxpayer tried to say is, well, part of my return as an LLC member, part of it was capital and part of it was for services. So the part that was for capital, since that didn't relate to services, it shouldn't be self-employment tax. And the IRS said, no, there's no statutory distinction between a return for capital and a return for services. Once you're a general partner, you're taxed on the whole thing. So you walk like a duck, you talk like a duck, you quack like a duck, that's it. We can't parse out why you got your interest. You're active, so you get self-employment tax. So that's what that case said. And so I don't think that people using LLCs, I don't think you should use an LLC if you want to get the exclusion. You might qualify under the proposed regs, and the IRS might give you a break. And there are a lot of people getting away with it, so I'm not saying you can't, it's impossible to do. The proposed regs say that in order to fit for the limited partner exclusion, you have to have a different class of interest that's not active. You can't work for more than 500 hours a year. You can't guarantee debts. So that's a very tough way to fit in. And furthermore, if you don't work enough in the business, you might get subject to the 3.8% tax on that investment income. Now, that might very well go away with the Trump administration, that tax. But the proposal does talk about having favorable rates for people who are active business owners. It doesn't necessarily say there will be a favorable rate for passive business owners. So you may find that you need to be an active business owner to get a favorable income tax rate, which could vary between 8% if the House Republicans have their way, or as much as 18% if President Trump has his way in terms of the active business exclusion. So the active business exclusion will provide perhaps an even bigger tax benefit than the 3.8% net investment income tax. So you still need to find a way to actively participate and get the limited partner exclusion. And the only way to do that is to have a limited partnership, to be safe, to have a limited partnership. And if you don't like the limited partnership business model, you can have the limited partnership own an LLC, do your business through the LLC subsidiary, and run your business through the LLC subsidiary, and on your day-to-day basis. So my materials go into that a lot more detail, but we don't have enough time to go over all of that right now because I have a lot of other topics that you'd be interested in. Now, the next code is square hole. That's the code word because I think using an LLC to try to avoid self-employment tax is fitting a round peg into a square hole. So I'm concluding that this part with square hole. Let's go on and talk about the new partnership audit rules. First, I'm going to talk about the consequences of these rules that come into effect in 2018, and then I'm going to talk about who's eligible for it. Now, the consequences of these new partnership rules that come into effect in 2018, first of all, partner-level defenses do not apply. The partnership would be audited under these new rules, and everything would apply at the partnership level. If a partner has special circumstances that need to be considered, that's not really necessarily going to be on the table. So this was a streamlined method, and these new rules, they generally are attacking people who have more than 100 partners, and that's what they were really promoted as being. But we'll see when we get to the next slide that they actually have a far-reaching application besides that. Okay, so another aspect to the new partnership audit rules is that the highest tax rate under Code Section 1, which is our ordinary income tax, or Code Section 11, which is our long-term capital gain rates, the highest tax rate on that will apply to any adjustment that is made. So you might have a partner who's in a low tax bracket, and any income that they, any deduction that they had a very small benefit. IRS come back to the audits, they audit at the partnership level. The partnership would be paying the tax at the higher rate. So that's a tough one. That might not necessarily be really the toughest aspect of it. Another tough aspect of it has to do with adjusting income allocations. So what's that all about? When you have partnerships, partnership taxation is really the most favorable income tax in terms of flexibility and ability to obtain a lot of tax benefits. It's terrific. The problem is that it's potentially subject to abuse, and there are rules on how you can allocate items to people. Because taxpayers like to allocate income to the taxpayers that have the lowest rates or maybe tax-exempt entities, and they like to allocate deductions to the partners who have the highest rates. And so taxpayers have played games in the past, and the IRS has come out against that, and they'll audit partnership returns, and they'll say, hey, you did your allocations wrong. Partner A was not allocated enough income, so we're gonna allocate income to partner A because that's a higher level of tax, and we're gonna reduce the income that got allocated to partner B. Well, the tax law itself, the only mechanism it really has is that when we allocate income to partner A, the partnership will pay the tax on it. Well, what about when partner B's income gets reduced? Well, there's no mechanism in the statute for giving a tax benefit for the reduction in the income that got allocated to B. So there might be an extra taxation. Now, I think that might be remedied by regulations, and in fact, proposed regulations came out just last week. I haven't been able to analyze them yet, so we'll see what everybody who analyzes them comes up with. But I just wanted to alert everybody to the fact that there's a possible mismatch if there's income allocated to partners and there's no corresponding benefit when there's an IRS audit. The next issue has to do with amended partnership returns. So normally you amend a return, you just file your amended return. Well, that's not what you have to do under this new statute. What you would have instead is you would have to file with the IRS a special request for an administrative adjustment. So you file an administrative adjustment request, and then have that run through the IRS system. So it's not like a self-help where you amend your return and then people amend their K-1s. You have to go into the IRS. Here's my change, and here's how we're going to amend our returns to do all this. So there's a lot more complexity under these new partnership audit rules. Furthermore, the IRS audit rate has been very, very low in the past because the general rule is you have to audit each partner's return after you audit the partnership. So you audit the partnership return and then you apply it at each person's individual level, and so there's a lot of work involved in auditing not only the partnership return but also the partner's return. And having this done at the partnership level will make it a lot easier for the IRS. That also means it's going to increase your audit rate from a very small audit rate to possibly a much bigger audit rate. It's going to be a lot easier for the IRS to audit and collect tax. So those who are within these rules are going to be much more susceptible to audit and the imposition of tax and a more complex and less favorable audit procedure. Whereas if there's a way you can get out of it, then we ought to pursue that. So the next slide, slide 8, the partnership audit rules, you would like to see whether you can opt out of these rules. So first of all, the partnership would have to annually opt out of these rules. It's not like you can opt out once and then you're out of these rules. You have to opt out every single year. The partnership has to issue 100 or fewer statements, is what the law says. But by statements, they really mean K-1s. So you'd have to have 100 or fewer partners who are receiving K-1s. It could also be assignees, but anybody who has an economic interest who receives a K-1. The other issue is who are your partners? The partners have to be eligible. If you have a single ineligible partner, it throws you into the new rules. So all of your partners need to be eligible. And generally, the only taxpayers who are eligible partners are individuals, corporations, or estates. Corporations could be C corporations or S corporations. So those are the eligible partners. So who would not be eligible under that? Well, trusts come to mind. So what happens if you hold your partnership in a grantor trust? Does that count? Grantor trusts are generally disregarded for income tax purposes, but they are legally the owners. So does the grantor trust count? Well, when the statute was passed, the Joint Committee on Taxation put out its comments on it, what we call the Blue Book. And the Joint Committee on Taxation said, we anticipate that grantor trusts would be eligible owners while it's taxable as a grantor trust and during the 2 years after the person dies. And they also made comments about maybe having tiered partnerships being owners. Well, the proposed regulations that came out last week said, we are not making any exception for trusts. And we're not going to allow you to have tiered structures either. Now, what's that in the background of? They said, commentators said we should allow grantor trusts and other tiered structures. And all those commentators talked about the burden on taxpayers. Well, the whole point about this rule was, this new law is relieving the IRS's burden. And you guys didn't talk about the IRS's burden. So until you tell us about the IRS's burden, we're not going to exempt any trusts. So potentially, if you hold your partnership in a partnership interest in a revocable trust, you're going to be an ineligible partner, and you're going to be stuck under these new rules. Now, ACTEC did make comments saying we should allow trusts, grantor trusts and non-grantor trusts, and then the IRS did not follow those comments. ACTEC will be making some more comments about in response to the proposed regulations, and we'll see whether the Treasury will change their mind, but we're going to at least make a comment on revocable trusts, that there won't be an administrative burden on a revocable trust. So we will wind up responding to that, but you can stay tuned for that. So we'll see where that goes. So S corporations, though, they said, even though they said we're not going to allow you to be tiered entities, they said we don't care who the owners of an S corporation are. So you could have a trust that owns an S corporation, and so maybe the trust will create an S corporation to hold a partnership interest. That would make it eligible. Now, I would not run out to create an S corporation right now. We need to wait to see what the proposed regulations say. I'm sorry, what the final regulations say. And I imagine the final regulations will be issued later this year because everybody needs to know what to do for 2018. So I would not run out and run the S Corp yet, but in the fall, maybe we can talk some more about whether you should interpose an S corporation for this. Okay, so I'm done talking about the partnership rule. Let's see. Oh, here's a question. Are the eligibility requirements to opt out conjunctive or disjunctive? Can a 3-owner partnership with a non-eligible owner opt out? So the answer is no. If the 3-owner partnership has a non-eligible owner, they cannot opt out. All of your owners have to be eligible. So tough luck. That's the rules. And I'm sorry, that's what they are, but that's what they are. Okay. Let's go on, and I know a lot of people who logged in were interested in hearing about some of the best from Heckerling. So, I mean, I do have something in my newsletter that talks about fiduciary income tax and particularly about the charitable. I think those are all important topics. And in fact, on February 7th, I'm going to have a webinar that goes through the various things that were in my newsletter about the top 10 list for fiduciary income tax preparers. But right now, I'm not going into that. I'm going to talk into just particular topics that we covered in our Heckerling presentation, and there's a separate handout that was on the web page that's from our Heckerling materials. Yes, I'll take that trust fully loaded, and this is a collaborative effort between Jonathan Blattmacher, Mickey Davis, Steve Tritton, and me. And Steve Tritton was our program chair, and Jonathan Blattmacher has an interactive legal system of drafting trust, and that's what generated the model trust that's in the materials. I'm just going to cover some selected topics from that, and I do encourage people to email in questions about these trust provisions. So this is going to be more strategic, although the first one is kind of covered, going to be covered now on February 7th. The Code Section 6482C deduction. So this relates to the trust income tax deduction for contributions made to charities. Now, a trust generally has an unlimited deduction for contributions that it makes to charity. Now, the contribution has to be made out of the trust gross income, and you need to have received the income before you make the distribution. But this is an unlimited amount, and a really neat thing is this unlimited contribution applies to deductions made during the relevant tax year or the year thereafter. What do I mean by that? Any contribution made until December 31st, 2017 can be deducted on the 2016 income tax return. So that's a little bit of retroactive tax planning that the code gives you. It's a really nice feature. Now, if the trust has business income, then that deduction will be limited. And I don't have time to go into that right now. I just want to give you that caveat. But if you're just talking about interest and dividends, capital gains, okay, this deduction is unlimited against that income. Now, contrast that to an individual. An individual can get a deduction for only 20, 30, or 50% of their adjusted gross income, depending on what type of charity and what type of property it is. And so this is a lot more favorable coming out of a trust. It's also one of the very few deductions that it reduces the trust net investment income subject to the net investment income tax. If a trust makes a charitable contribution, that reduces the amount subject to 3.8% tax on net investment income. If an individual makes a charitable contribution, that does not reduce the income subject to net investment income tax. So the 642C deduction is much more valuable done through a trust than by a beneficiary, by an individual. Now, what about tax reform? Is that going to affect this at all? Well, one of the big things that's been discussed is lower rates in exchange for curbing deductions. And proposals out there would limit people's itemized deductions, limit individuals' charitable deduction. Now, they haven't really talked about whether they're going to extend this at all to trusts. We might very well be in an environment where an individual's charitable deductions are severely limited, but a charity's deductions are unlimited. So it's possible that what people might need to do in the future is to create what's called an incomplete gift non-grantor trust, where a very, very wealthy person would contribute big amounts of assets to a trust that's not a completed gift for gift tax purposes, so it doesn't really save any estate tax. But for income tax purposes, the income is taxed to the trust. And then you would make the charitable donations out of that trust. So you get an unlimited charitable deduction against that investment income generated by that trust. Whereas if the person had kept that income outside of the trust, then you wouldn't have been able to take the charitable deduction against it because of any limits that tax reform might impose. So again, I'm not saying they're going to totally do away charitable deductions. They would just limit them, and they might limit them to the point that you might not get a benefit from deductions over a certain amount. So to get the Section 642C deduction, the trust must authorize the distributions to charity. And the IRS has gotten very strict on that. And in fact, the IRS generally does not audit trust income tax returns, but there have been cases and rulings that have come out in the past several years where it will audit the Section 642C deduction. So be very careful. Make sure you have your ducks in a row. The trust agreement needs to authorize the distribution to charity, and the trust needs to earn the income before you make the distribution to the charity. And like I said, there's a one-year look back. One way to authorize it is to give the beneficiary a power to appoint to charity. So you can give the beneficiary the power to direct the trustee to make a distribution to charity. And so that might be a way to let the charitable deductions be done at the trust level instead of at the beneficiary's individual level. Now, you'd want to put limits on that potentially. I mean, you might not want a beneficiary who's just joined a cult go out and have the trust make a distribution to the cult. So you might want to have limits on that, and so it all depends on who your beneficiaries are, and maybe whether you want to have give the trustee or somebody else a veto power over that. So that's one planning point for charitable. Another planning point is allocating income to beneficiaries, and in those materials is Chapter 4 and Chapter 17, and so one of the things to think about is whether you need to have income trapped in the trust or distribute out to the beneficiary, and that's like, we're going to talk more about that on February 7th. But you'd like to have flexible income provisions. Capital gains, getting those distributed out to beneficiaries can be more difficult. You have to run through the regulations to see whether you can distribute your capital gains out to beneficiaries. I like having flexibility to allocate allocate capital gains to income or corpus. So I will put into my documents that the trustee can allocate capital gains to income or principal. And there's just an overall limitation that the trustee has to fairly and reasonably consider the interests of the income beneficiaries and the remainder men when you do that. And that language is in the materials. It's also in my longer business structuring materials. And again, that's going to be more in my February 7th webinar on that. But I just want to make sure that you think about having flexible provisions for that. And also the fact that when you have deductions inside the trust, you also have a lot of flexibility to which income you deduct those against. So that's all I want to cover for that. The 3.8% net investment income tax, again, that might very well go away. It's not worth spending a ton of time on it, but as I mentioned earlier, there might very well be under tax reform a big tax break, 8% to 18% for having active business income. So regardless of whether we have the 3.8% tax in place or tax reform, you're going to want to consider making sure that trustees materially participate in the business. And again, materials go through that a lot more, and my longer business structuring materials spend time on that. And so I encourage you to look at those issues. And even if it's a grantor trust, you want to look at that, because the grantor might turn off the grantor trust powers, or the grantor might die, and then poof, how are you going to make sure the trustee has been materially participating all these years? So you're going to want to think about that for a grantor trust as well. Okay, let's go to the next slide, which is the code word of flexible, because I'm a big believer in flexibility. And in these days of tax reform, you want to be very flexible. And in fact, all this tax reform, I think that the general consensus is that the president is not going to get 60 votes for what he does, and it's all going to be done through budget reconciliation, and it's going to be through a 10-year window. And in fact, by the time that 10-year window is over, we will have a new president, because the president can't serve more than 8 years. So you want to be flexible. Anything that is done can be undone. And by the way, in the tax reform proposals, they're using dynamic revenue scoring, and they are assuming that tax cuts and the cuts in regulation will cause our economic growth to skyrocket, and that the taxes that we'll raise because of our skyrocketing economic growth will overcome any tax decreases because of a cut in rates. And so these are all the assumptions that are underlying tax reform. And if we have a recession at some point, those assumptions will be blown out of the water, and our deficits will skyrocket, and that can create a very different taxing environment, very different deficit environment, and so we need to be very flexible. And I certainly do hope that whatever tax reforms we have and decrease the regulation do make the economy skyrocket, and I hope that everything goes with the economy the way the President would like to see them. Okay, slide 11. Again, more from Heckerling, talking about grantor trusts. And within our Heckerling materials, this was in Chapter 7 of the materials. And I do have a section in my business directory materials on grantor trust as well. But Chapter 7 in those materials refers to, it actually has some trust language in there. Now, let's again talk about this tax reform coming up. If there is a state tax repeal, it's unlikely that there will be 60 votes to make it permanent. In fact, President George W. Bush had a Republican Congress, and he supported repeal of estate taxes, and it never happened. They never got the 60 votes. They had the one-year repeal in 2010, and that was it. If we have estate tax repeal, it will be done through budget reconciliation, and the estate tax will be slated to come back. It came back. I mean, 2010, we had a one-year repeal. It came back in 2011. So I would not predict that any estate tax repeal will be permanent. If we did have a estate tax repeal that did ever become permanent, we still are concerned about grantor trust and gifting, and I'll go through that with you for a moment. So first of all, the gift tax is not slated for repeal. Estate tax and GST tax are slated for repeal, but not gift tax. They're keeping that in place. So if parents would like to get more to their children, more than $14,000 a year annual exclusion, it'll probably go up to $15,000 in 2018. We'll see. But you know, parents want to give more each year to their kids than the annual exclusion, then they're going to start eating up into their estate tax exemption. And parents do like. I've seen parents who they love getting stuff over into their grantor trust, not just to save estate taxes, but because it allows them to have big distributions to the kids from those trusts, and to support the children in a lifestyle that they couldn't support them themselves because they would be using up their exemptions. So grantor trust planning will be important. Another thing to consider is, what if the children are in lower brackets and grandchildren are in lower brackets? You know, if you have a married couple, if they have 2 or 3, maybe 5 kids, maybe they have a bunch of grandkids, once you start diffusing that income over a lot of people, you would have a lower rate. So people might want to shift wealth to their kids and grandkids in order to have a lower family income tax rate. And with the gift tax in place, we're still going to want to be doing grats and sales to irrevocable grantor trusts. You do your sale or your grat, the term ends, and then you turn off the grantor trust powers, and then make distributions to the kids and grandkids, and they will be able to get the tax at the lower rate. So you want to have grantor trust planning. It's going to be an important thing with or without tax reform, with or without a temporary state tax repeal. You want to have flexibility to be able to turn off your grantor trust powers. And so normally I have powers that are susceptible to having the grantor turn those off. And I will typically use a power to exchange assets, and then the grantor can always say, I release my power to exchange assets, therefore it's not a grantor trust anymore. There's also another power that can be used, a power for the trustee to make loans to the grantor. And if you draft that right, that can be a grantor trust. And then the grantor can say, I renounce my ability to borrow from the trust as a way of turning that off. If it's not a grantor trust, you could turn it into a grantor trust by using decanting. Or another way to do it is by having a merger. You have a trust that's not a grantor trust. The grantor creates an identical trust, but one that has the swap power in it that I mentioned. And then you have the old trust merged into the new trust. Now, the trust merger statutes all talk about beneficial interests in the trust being similar. But the swap power is not a beneficial interest. That just has to do with changing assets of equal value. So under the terms of most states' merger statutes, it would be pretty easy to merge a non-grantor trust into an identical grantor trust that has a swap power. The grantor could say, I'm turning off my swap power for the year 2018. That's all I'm turning it off for. So 2017, it's a grantor trust. 2018, it's not a grantor trust. 2019, it's a grantor trust again. There is an IRS notice that talks about if you toggle between grantor trust and non-grantor trust, that's a transaction of interest. But in there, people were like doing that to manipulate basis, things like that. They weren't just saying we just want to change who gets taxed. They were doing things, they were playing games with selling assets and manipulating basis. So toggling is not an evil thing. Another thing is I also put into the clause that an agent under the power of attorney can exercise or turn off the grantor trust power. So again, you're still keeping within the control of the grantor. So another thing is community property. In people who do have community property states, which are mainly the Southwest, Texas and California are big ones, Arizona, a number of other ones, and there's some elective community property states too. You have community property. Half of the trust is a grantor trust as to one spouse. Half is a grantor trust as to another, and so it can create some complications. So you want to just double check on who has those rights, and also you want to have separate sales. You want to have spouse 1 selling to spouse 1's grantor trust and spouse 2 selling to spouse 2's grantor trust. If you have spouse 1 selling to spouse 1 and spouse 2 jointly selling to a trust that's half spouse 1 and half spouse 2, you might have some tax consequences. I do not recommend having a tax reimbursement provision in your trust because that might subject it to creditors under the 2005 Bankruptcy Act. So I'd rather not do that. Okay, let's move on to retirement plan benefits. We talked about at Heckerling about drafting retirement plan trusts. In our outline that was in chapters 10, 11, and 12, comparing conduit trust and accumulation trusts and other retirement plan benefit issues. I'm not going to get into a lot of details on that. They're in your materials how you can do that. But one thing to be careful of is there's a very good chance that Stretch IRA will be repealed this year. Back in the last fall, the Senate Finance Committee unanimously approved a bill that would eliminate Stretch IRA for any beneficiary who is not a spouse. They had some limited exceptions for minors and incapacitated people. Be careful with your drafting. Have an alternative plan that says, if you need to use a beneficiary's life expectancy, here's how it works. If using the beneficiary's life expectancy is irrelevant because there's no stretch, then here's the other way it works. Or maybe you have a plan that works well either way. But when you draft a conduit trust, one that says that all distributions from the plan have to go to the beneficiary, make sure it says only if and to the extent necessary to use the beneficiary's life expectancy would that apply. Normally you're expecting, okay, if it's a beneficiary, suppose they're 40 years old, you can distribute 1/40th every year, that's 2.5% a year, that's not a big deal. But if you have to distribute out over 5 years, suddenly it's a big deal. So, so consider tax reform in that, or consider the possibility of repeal. So finally, S corporation trusts. S corporations are very flexible. You'll see in Chapter 8, there's some materials on that. And S corporation trusts, first of all, if you're a grantor trust, then I always like to make an electing small business trust election. Just in case, let me give you a horrible case that can occur. A person is selling their S corporation to a strategic buyer. Strategic buyer is paying double what it's worth otherwise. The strategic buyer has their accountants go through your tax attributes with a fine-tooth comb because they want to make sure they're getting a good S corporation. The buyer's tax advisors say, I'm not quite so sure this trust was a grantor trust. Maybe the S election was blown. Boom. That could kill the terms of the deal because now there's tax uncertainty that might cost, 10, 20, 30, 40% of the sale price. So you want to make 100% sure that your trust is qualified as a grantor, as an S corporation shareholder. So make an electing small business trust election to protect that. Well, there's a whole lot more. I encourage you to read the materials, encourage people to contact me with questions. But this is the time that we have allotted. And let me go to the next slide. Please sign up for my February 7th webinar. There should be a hot link to it in the slides that you download. And to my fiduciary income tax refresher and update, I have a blog, Business Succession Solutions, and I encourage you to subscribe to that, and then you can find out the most recent thing as soon as I get a webinar posted. It'll appear on that blog when it's going to be. Also, reports on Heckerling. There were 14 different reports that got issued on Heckerling, and I forwarded summaries of those, and you're welcome to link on that, and you will find there a bunch of useful information for Heckerling. So thank you very much for attending. Please complete your evaluations and take the time to send those back, and I'm welcome any input you might have. Thank you.